no one cares about your company. No one cares about you. People care about the story you have and what you can do for them. So I think it's shifting that perspective of people feel as though they have a window of time to tell as much information as possible. Like, get it all out there. That is a awful approach to things. Like, leave a little bit to the imagination, make them a little bit curious, understand where they're coming from. And like the simplest thing is like, read it out loud. Would you respond to it? If the answer is no, do something else.
Tim is one of the most authentic and genuine people I've ever met.
Sincerely believe he's coming from a position of giving, and that means a lot.
You're going to make huge progress.
Hi, everybody. Welcome to today's capital raising show. I'm your host, Tim Mai. And today I have an amazing capital raiser, syndicator, fund manager on the line with us, Sam Silverman. He's been a passive investor for a few years. However, in terms of having his own fund, it's only been 18 months and he's already raised $43 million for the fund. And so I'm super excited to learn how all he's done it, and how his model is very unique, different from a lot of people. So let's give a big warm welcome for Mr. Sam Silverman. Yay!
Cool. Thanks, Tim.
Awesome. All right, Sam. Yeah. So why don't we start with, if you can share with everybody a little bit about your journey. How did you get here into this syndication space?
So in terms of kind of the real estate side of the house, I started like most people do in single family, right? Built a portfolio of single family houses, not too soon after college, and realized, really quickly that it wasn't worth the trade-off my time for it, right? I was moving up really quickly in the world of sales. And in the world of sales, especially in tech, you've got a lot of money that can be made in your variable earnings or your commission, right? So what I was realizing is that I was spending far too much time looking for deals, working with lenders, managing a project versus having time being spent in my day job that gave me actually a lot more upside than each single family house did, right? The portfolio is maybe 10 houses in total. So you push rents an extra $100 a property, right? It doesn't really move the needle for you too much versus how much you can really go make in your day job. So eventually started selling properties off, got into LP investing, and then got into like 17 or 18 deals prior to going active, right? Just kind of writing a check, being truly hands off. Started kind of funneling all the money into those deals. Then I kind of realized that there's, especially in multi, right, or kind of more the commercial space, there's really two things that matter, right? Especially, well, if you're starting out, one, you find a deal, two, you find money. And for myself, I fell much more in the latter camp just because my background in tech, I led and trained large teams where their sole job was, here's a list of accounts, go find the executives in those accounts and book a meeting for a more senior seller, right? So I already could profile people extremely well as to, who's a good investor, who can I get a conversation with? And when you think about it, right, kind of being in sales leadership, I was my exact profile investor. And what I've seen is that the better you know your end buyer, your end investor, the better you can kind of position what you're doing to align to who they are, what they want, what they need. So started going active on the kind of capital raising, investor relations, marketing side of the house 18, 19 months ago or so. And now we're closing in about $50 million in the next, probably next month, I'll hit $50 million in terms of capital raised. So it's growing really quickly. But yeah, I definitely have a really big focus on just working with great operators, right? More so kind of partnering accordingly in deals. Yeah, definitely focus a ton on the investor side of the house.
That's awesome. When you first got started, I guess as an LP, you probably didn't join any mentorship program, but as you transition over to the active side of things, did you join any type of mentorship or mastermind program?
So yeah, I joined one mastermind community and actually left that community after my 1 year was up, more so because it was focused more so on people who were kind of doing smaller deals themselves, right? So not really the world I was playing in, right? I more so wanted to do the institutional quality size type deals with more experienced operators, right? Kind of latch on to a team like that. So when I first started, it actually helped me a lot in the sense that I had already written checks to a lot of really good operators, right? Myself as an LP. So asking for someone's time when you wrote, giving them over $100,000 is a lot easier when you have it, right? So you kind of buy your way into it. So I kind of viewed it as a very highly paid education course on what you should and what you should not do from the investor experience standpoint. So I already had people I could go to for questions, people I can go to for partnerships that were more so pushing me to get started versus me pushing, right? So it was a lot easier to process because of that.
That's awesome. Yeah. And so let's dig into that. So, started out as an investor. And you mentioned you were a passive investor in 17 deals. Is that correct?
I was. Now I think I'm up to 748 in total. So every deal that I sponsor, I also invest in myself. It's all invested into. I've got nothing in the stock market for right or wrong. I've got a few bucks into a crypto fund just so I don't feel left out. Maybe being left out would have been better at this point, but outside of that, it's just all into syndications and funds.
Gotcha. Okay. So coming from, passive investing with that background, how have you approached passive investors for your own capital raise perhaps differently than what most people do? Or what are some of the effective ways that you see about,
Sure.
okay, I see this is a need, I see this is the target audience, yeah, give us an insight into that.
So for me, I think it's really important to understand who your profile of investor is, right? Like very, very intimately. So for mine, I kind of have two main profiles. One, kind of look at them as the up and comer, right? They're 24 to 35 years old. They're a mid-market account executive to a director of sales, likely in tech. For them, they're making between $150,000 and $300,000 per year, right? So they're kind of a group of people who they can have a great overall value, right? Because they could be a $10 million plus investor over their full life. Think about a 24-year-old kid in tech making 200 grand a year. It's likely safe to say that they'll keep working their way up. But for them, right, they invest as they receive capital, whether they get an equity vest, whether they get a big commission check, right? The other group of people, kind of the larger check folks I have, they're VPs of sales, CROs, founders of tech companies, right? They're executives in that sense, where they're making $400,000 plus a year, typically 35 years or older, some a little bit younger, right? But they've already had that big earning period for them, right? They're worth between probably $500,000 lowest end up, $10 million plus they've had any exits. And for them, it's more of a prove it model, right? Where if you perform well, they have money in retirement accounts, in brokerage accounts, in cash, right? They're getting bigger chunks at one time. So for them, they can be a much larger overall investor much quicker for you if you give them a good experience, right? So when you're working on the kind of money side of the house, making sure that your investors have a good experience, not just good returns, right? Both really matter, but I think they're almost equally important, is that, right, giving them a good experience allows them to go reinvest before they have an actual exit. Because if you're getting one check from someone waiting 5 years, right, like it's a really, really slow growth period for you. You want to give people that confidence they can go keep reallocating dollars to you. But then the biggest thing that it helps me with is that I can speak to things from the investor standpoint much more so than other people can, both on the how I bet sponsors, both on the what I personally invest in, how I break up my portfolio, cash flow versus growth, right? How I kind of evaluate all those pieces of it, where I can probably talk that a lot more than other people can, who have just only focused in one area, one market, one asset class, where I've done quite a bit of diversity because of who I can work with and partner accordingly.
Gotcha. That's awesome. And I noticed in your description of your avatar, they're mostly tech salespeople, which is your background. And so, so that, yeah, and we do see that trend a lot of times in, in others. If someone's from Silicon Valley, that's where they raise most of their money. And so with you with you focusing on the tech salespeople, you're able to speak. You probably know their pain points, like the way they think a lot more. Can you explain into if for everyone on the line, no matter what industry that they are in, what are some of the tips, I guess, around how to target the people that are in your profession, so that way, yeah.
Your profession may not make sense to go target, right? Like the way I view, there's a few things that they need to have for it to make sense. One, do they have money, right? Like if you're targeting people making 50 grand a year, if you have access to them, great, but like don't waste your time there. You want people who can invest at least once per year, ideally more than that. And also think too, the people who you're working with, they're likely have similar connections to referrals. So if you get in the right groups, those referrals can be very, very meaningful for you. So one, make sure they have money, right? Two, make sure you have some level of common ground or educate yourself to have a level of common ground understanding as to who they are as people. Then 3, make sure you can have access to them. And for me, like it was always easiest on LinkedIn, right? Because I lived on there for work all day long. And if you're in sales, you live on LinkedIn all day long to make your living, right? Say, for example, you target doctors. Great profile to go target, but they don't need LinkedIn for their job, right? My profile person, they are living on that to make their living. So for me, like there's probably ways to go target doctors that I'm just not aware of because I haven't had to go do it, right? But I knew that I had one, they have money. I can tell you how much someone makes when I pull up their profile, right? Roughly based on the company size, role, tenure, how long they've been there. And second, I know who they are as people, right? So I have a very compelling story, very common ground, right? They have respect and kind of mutual transferable respect because of my previous roles and success in those roles. Then third, I have access to millions of people who fit my profile of person who I can go work with, right? So I think those 3 things matter the most. Of 1, do they have money? 2, do you have a common story? And 3, can you get in front of them?
That's really good. So if you are in a profession where people don't make that much money, let's say they all make under $100,000 a year, what would be the next best thing to go do to find, what's the niche with the people with money?
So give me an example of profession, because there's likely a lot of commonalities in professions, right? That can transfer over, right? So say, for example, it's construction workers, right? And they, for that role, they're making 40 to 70 grand a year, maybe a few bucks more. But you may have access and have a similar storyline to go target all of the developers and superintendents, right? You can kind of work your way up in that same field of different roles. You still have that commonality and that knowledge there. So I'd say you can probably find, every field there's roles that are much higher paid than others. So go find those roles in that same field, but you have that storyline too to go work with.
I see. That's a good point. Okay. And then so in your case, like you said, your people live on LinkedIn, so LinkedIn is the best resource for you. How do you suggest people find for their niche, whatever that is, like find where their people hang out to target them more?
If you don't know where your people spend time, you likely have done enough research on that profile of person, right? Like for example, say there's all these massive doctors and dentist groups, right? So all of those things, definitely like digging into is really important. But yeah, I mean, just kind of understanding, where those people live. Like, I don't have the answer for you as to how you go find that, but like there has to be podcasts on, there has to be different groups on it, right? Like spend some time doing due diligence as to seeing where they spend their time, right? Like say all these fields that are certification based, think, doctors or anything in the medical field. There's continuing ed, right? Can you go join a continuing ed class? Can you go join a seminar, right? All those things, spend a few bucks to get in front of a few of them and go talk to them, right? Go find a few of them, pay them for their time and ask them, hey, where do you guys spend your time for information? What can't you live without? What groups do you guys have to get in front of, right? So kind of understanding where they live. I don't have the answer as to where certain profiles live, but I can probably go figure out if I spend some time doing it as to, where I can get in front of big groups of them.
Right. Okay. So in your case, let's say it's a brand new person, you don't know them, you're reaching out on LinkedIn. What is your approach to them? What's the first thing that you say or do?
So it depends, right? Because we kind of target a few people for myself, right? 1 are just potential retail investors. 2 are potential fund managers raise capital for us, right? So looking at the former, right? I'll either, if they're part of, I run a passive investing channel in a sales leadership community, I'll try and drive them to that channel, right? More so my goal on LinkedIn is connecting with someone and just get them to accept, right? Like you're very, very soft. You're not overly pitching them, get them to accept, and that's it. Right. From there, you can, drive them to a group you have, you can drive them to your LinkedIn profile page, you can drive them to your company page, right? Because basically if I add you on LinkedIn, Tim, and you're like, you accept it, I'm like, hey, Tim, check out Silverman Capital, you follow it. I wait a week or so. It's a lot easier saying, hey, Tim, thanks for following Silverman Capital. If you're ever interested in kind of the offerings we have, feel free to sign up here. Or if you're interested in talking about real estate, happy to have a conversation. We're like very, very soft asks. But the thing is, when you look at LinkedIn, you get 150 contacts per week that you can go add. That's 7,500 per year. You convert 1% of those of people you reach out to per year at 100K a piece. That's $7.5 million a year. Stack it for 4 years. That's $30 million a year of capital you can go raise, right? Because people typically stay and give you referrals as well. So you have that, if you're not maxing out your connections every week on LinkedIn and being purposeful about how you follow up with them, you're leaving money on the table in doing so.
Gotcha.
Hey,
Okay.
Hey, Tim, if I could, I know we got a short window here. Sam, I'd like to ask you something here, which you kind of touched on it a little bit here, but I want to do a little bit deeper dive here. With backgrounds in marketing and hooks and copy and all this stuff that Tim and I have in the marketing space, info space, when you're talking about targeting people, an avatar of a person, say a doctor or a dentist, whatever that avatar is, on LinkedIn, you have to understand, obviously, that these people get hit up and pitched all the time, right? From capital raisers, fund managers.
Yes and no.
Okay, so let's put a pin in
So
that.
your competition. Yeah, go ahead.
So then the question is, then how do you stand out? How do you stand out from the noise they're already hearing? So I'll shut up and let you have at it.
So I don't think you're actually pitching anyone, right? Like you're not going to go push someone's deal down your throat, right? Like
no.
People. No. So, but that's what your competition is doing though, right? So like your competition is space, which is why I was so gung ho about it. It's franchise consultants who, if you look at their LinkedIn pitches, they are brutal. Or if you look at financial advisors under FINRA, right? Like it is the most generic, horrible copy you can have. So the way I view it is like done, not perfect, in the sense of make that one little extra step that takes you 5 seconds more. Doesn't look like it's copy and pasted, and you'll separate yourself from the 90% of people instantly, right? So it's not enough. You're not doing enough where it's taking up all of your time for one note, but it's doing just enough where it's not looking like everyone else's approach to it. Find one commonality, find one common connection, right? Tell a story. So what I found works the best on social is like long form content with personal stories. And they're a pain in the ass to actually go right. But you can repurpose that same article over and over and over again really easily. Like for me, like I wrote one on, why I went from active to passive investing, and every sales leader, right? For me, half of them already thought investing in real estate in some capacity, right? So I'm like, hey, thanks for connecting. If you're ever curious, this is an article I wrote on, why I chose this route in real estate investing. If you have any questions, let me know. Right. So like not super hard asks, right? Where you're kind of forcing a conversation. More so, hey, you might find this interesting. Check out these few bullet points here. If it's interesting, let me know and let's talk. Right. So very, very soft versus the whole, 3-paragraph block of a pitch about your company. No one cares about your company. No one cares about you. People care about the story you have and what you can do for them. So I think it's shifting that perspective of people feel as though they have a window of time to tell as much information as possible. Like get it all out there. That is a awful approach to things. Like leave a little bit to the imagination, make them a little bit curious, understand where they're coming from. And like the simplest thing is like, read it out loud. Would you respond to it? If the answer is no, do something else, right? Like we interact like freaking robots half the time. We're communicating with people on messaging and email, right? Like read it out loud, have a conversation, use simple language, and it typically goes a pretty long way.
I love that. Read it, read it to yourself. And would you even respond to that? And if not, or if it sounds odd, then go, I'm not.
Because it doesn't sound like it's your voice and you read it out loud, you're like, who is this person saying this? And then like be yourself. I think, what I've seen too, I've managed hundreds of sales reps in my career, and people could do things really differently and both do really well. You have to kind of figure it out. Like, what's that approach for yourself that works really well for you that kind of comes through as who you are, right? Otherwise, it just becomes very forced. It feels very generic. So kind of figuring out kind of what your tonality and language is, you can do stuff like that, I think will help a ton.
That's really good. And, one of the things you mentioned is you send them an article. And when you send them an article, it does a few things, actually. Number one, you're giving them information, right? So it's like, oh, he's giving me resources. And then number two, because you're the author, you wrote it, like it's instant credibility in their eyes. It's like, oh, this guy must be an expert, subject matter expert at this, since he wrote this article, right? And so
you don't need a lot of them either. Like you need 2 or 3 good ones, a few podcasts that you may be done. You can go keep repurposing that over and over and over again. But yeah, like Tim nailed it. Like you want to have content that's yours versus saying, hey, so-and-so, thanks for connecting. Here's this cool article that Tim wrote that I'm gonna go share with you. You're gonna go talk to Tim, not me, right? Like I'm basically promoting for Tim then. You see a lot of these big kind of, name brands in the space who pump out content. And at first it's really easy to use some content, but you quickly realize like, take the time and write it yourself. because that way, every time someone reads it, it's a chance to get a better understanding of who you are. And people invest in people. Like in my eyes, it's, you know, people, market, deal all day long in that order of what I care about as an investor. And, you know, like it gives you a chance to kind of see things through your eyes and your perspective and your philosophy and kind of what your values are as well as to how you frame things.
Yeah, that's really good. And for those of you, if you're new, so I'm fairly new to this space, and so you know, at first I wanted to understand what a passive investor look for. So I went and interviewed Trevor Thompson was one of my first you know, interview around passive investing. So I get to understand, okay, you've done all these passive investing, you know, what do you look for? How do you vet the, you know, the operator, the deals, you know, all of that stuff. And so just through that interview, and I did a few people like that, I get to come to my own way of looking at this. And so if I wanted to write an article on that, you know, it's almost like a summary, right? And so it still can be in my voice and not Trevor's voice, as an example. So that is a
Yeah,
really,
like,
yeah.
yeah, and I was gonna say like repurposing someone else's content that they've already kind of pushed out there is a great opportunity to go start too. That's a much easier lift. Like for example, if, you know, Trevor wrote an awesome article on investing as an LP and you want to go kind of use some of his main points and put them in your own language, right? That's totally fine to go do as well. But yeah, stuff like that, it helps and kind of help bridge that gap really quickly.
Yeah, that's really good. In terms of technology wise, since you are in the tech space, what tech do you use to help you in your business?
So to be fair, I was a sales guy in the tech space, right? Like I was in no way a tech guy, right? To me, tech sales and just sales in general is explaining complex things simply. But I was in no way competent at using any of the tech that I actually sold. So for tech, like mine's super simple. I've got, you know, a website, I've got MailChimp. I live on, you know, Zoom when I have to. I prefer phone calls. I hate being on camera. But, you know, I really don't use a ton of tech in my business. Like they have stuff for linked automation, they have stuff for active campaign automation, they have all these things, but I think they're great if you already have your stuff together. But if people get, just my opinion, people get so caught up in the tech of what they're doing, like doing good work beats that all day long. Of like tech doesn't solve your issues, right? It's what you put into the tech that actually helps make it better, right? So tech makes you operate more efficiently if you have good stuff to go share, a good message to get across. If you don't, you're just pushing out more of stuff that likely isn't like going to go convert. So in my opinion, like get your fundamentals down of your messaging, your profile of investor. That will serve you 100 times better when you're first starting out versus having the coolest tech. In my opinion, the cool tech will help you move faster once you have that stuff down, if used the right way.
That's awesome. So let's talk about funds. What made you decide to go to the fund model? Number one, and then number two, I know you do a lot with others around the fund of funds model as well. So we'll start with your own fund, and then we'll talk about, you know, the network that you build with the fund of funds. Yeah.
Yep. So we're launching a fund for short here on Monday. It's a 506c. So we'll talk about that one specifically. We chose the fund route for that asset class because they're smaller assets. Like our average purchase price will be between $500,000 and $600,000. And if you want to go raise $100 million next year and you want to do individual transactions, like that's just going to be a waste of money, and my hair would be a lot more gray going into next year. Like it's just not possible to go do it. So we do that much more as a portfolio roll-up type play versus a kind of versus individual deals, just because it's too small, right, in terms of the individual assets. So for us, we plan to raise all of our capital there for our next year's fund in a one, it's 506c, but two, in a fund to fund capacity, where we do no co-GP for compliance reasons. I think you see a lot of deals with 10, 12 co-GPs in them right now, especially as the leverage has gone down, equity has gone up, and for the same project. So we believe it's a big compliance risk. So for us, all of our capital comes in a fund of fund structure, meaning that we have classes of shares based on your capital contribution. They give you better economics versus the retail investor. So you can add an acquisition fee, you can add an AUM fee, build out your promote, build out your split. So actually in our higher class of shares, based on our pro forma, the capital raiser can actually make far more per dollar raised in a transaction like this versus in a co-GP type model. And without all the compliance risk as well, right? So we see it as, a really good avenue for fund managers have some creativity, to have some flexibility how they structure things, and also just for compliance too. Like, I'm younger, I want to be doing this for a long time, so compliance is something we walk a very, very tight line with, just to ensure we can keep stay in the business for long enough.
Right. So in the fund of fund model, you mentioned about the acquisition fee. So are you referring to the acquisition fee that you are, as a fund manager, charging to your investors, correct?
Correct.
Okay.
Yep. So as a fund manager, investing into a larger entity that you're kind of pooling investors together to come in as one entity for a larger check, you can add things like an acquisition fee up front, an AUM fee if you want to take an carry fee, and then you have a promote between after your pref that you earn a percentage of, right? So you have a lot of flexibility. Like, we have fund managers who put on no fees, we have fund managers who put a lot of fees, right? You have a level of flexibility based on what your investors will tolerate and expect. I kind of view it as like a balancing act, right? We have some people who offer better returns than we do directly, but some people offer much worse terms than we do directly. But it's all what their investors and what they believe they can go sell, right? So we always defer to them. We have no involvement as they structure it. It's more so whatever they choose to go do, they have that level of creativity and flexibility based on their network and their people. So
right. And then on the operator that you are funding their deals, what do you normally negotiate on their deal as a fund of fund?
So for me personally,
Yeah.
so in the one group I do this with historically, I'm actually on there's 3 of us on the GP, I'm one of them. Just because I've involvement past the kind of fund manager side of it, right? So I manage the fund managers, I do all of our marketing, all of our legal structure, all of our fund structure, kind of head of investment strategy as well. So I play a lot more roles there than just helping source capital through fund managers. So for me, I have a fixed percentages of the GP in that transaction, right? It's fixed, not variable based on performance. It is a fixed flat rate as equity in the company. Yeah.
Okay, so let me make sure that I'm clear. So this company you just mentioned, so that's the lead GP for the property, not your funds. That's correct. And then your fund is separately. So let's say you have
so I'm on the main fund of that. I don't have my individual fund. It's me and 2 partners run that fund. My role is kind of all things investors, marketing, legal structure, and then they're more on the true operational of the asset side of the house.
Okay.
So yeah, it's 3 of us on it. Correct.
Yeah, I understand now. So does your fund with the 2 partners that you have ever fund someone else's deal?
No.
Okay.
Nope. All the go to assets that we own and control ourselves, fully vertically integrated. But yeah, all those assets we own and control ourselves.
Gotcha. Okay. Now, I know at one point you and I chat a little bit. You mentioned something about you also have a network that you teach them the fund of fund model, and then their fund raise money for your funds. Is that correct?
Yep. So we definitely help people get going in the kind of the fund manager routes. We have systems in place to help support bringing on new fund managers. And I've done this myself as a fund manager 15 times. We've had 20 plus fund managers raise capital for us as well. I definitely have a deep experience in this field, but it's not something I go charge people for to go do it. It's more so I do it to help facilitate them raising capital for us.
Gotcha. And then so when they do that and they're raising capital for your deal and your fund, how do you pay their fund that is differently?
We have certain classes of shares, right? Their promote and pref can go up based on their capital contribution. So rather than a class A and a class B, we have 8 classes of shares that we use that have a higher pref and higher promote based on their check size. So whatever they bring in, they fall into that class of share.
And you said
so basically
8?
We're taking that 8. Yep.
Wow. Okay. Give us a
It'll
little.
save you a lot of side letters.
Yeah. Give us just a little rundown. Like, let's say the first 3 of those 8. What
So
does that look like?
I can give you the range of it. So our retail investors are 8% pref and a 50-50 split, or they will be at our fund we're launching on Monday. And then we have institutional type terms for $5 million plus that can be 9% pref and a 90-10 split, right? So we have and everything in between. So it's more so based on their check size. It's basically kind of us pushing what would have been that GP that we would have given to a co-GP into the LP equity that they receive instead. And so we have a much cleaner operating agreement and balance sheet.
Gotcha. Very cool. All right. Yeah. So in terms of just funds and stuff, I know a lot of people on here does syndications, not do fund, is doing the fund model, especially the fund of fund model versus versus a normal syndication. Is it a lot less expensive legally wise with the legal structure, or is that more cost involved to do that?
Our main fund is still kind of similar to a syndication in terms of our legal costs internally. But we have kind of pre-negotiated kind of mini PPM rates with our legal counsel as well for fund managers who want to use that, right? So for them, we've kind of pre-negotiated rates for kind of mini documents because they build up our main docs, right? So it's a lesser cost there. So basically have kind of pre-negotiated rates with them, with a CPA for K1s, right? With a back office team that they can go leverage if they want to. They're they're not obligated to. We have that negotiated for them if they do choose to go do so.
Very cool. I like that. Okay. Now with this, I know your fund is a short-term rental fund. Share with us, what your take is with this upcoming market, in the next 18, 24 months here, where you see the markets going and how is your fund positioned to either take advantage of that market or navigate through that market?
So the nice thing with us, we have a few things I think are relevant here. Is one, short-term rentals have the highest yield out of any asset class I've seen, right? Which means that when rates go up, we're impacted the least. Multifamily right now, you're seeing 2, 3, 4% yield in year one, right? We're well above that. Our projections are well above that because of how much cash flow we actually have from these properties. So we're least impacted there. I also see this as a big opportunity in our end. So if you look at it in multifamily today, you can go buy an asset for $100 million tomorrow, write an equity check of $50 million, because that's probably how much you need to go take that down today. And the institution can do that all day long. And what that means is that you've already seen compression in that asset class because of institutional capital flooding in there, right? So you have multi, you have self-storage, mobile home parks, RV campgrounds are coming up really big as well. Short-term rentals are very early. So what I view in this space is there's kind of insulation for a few reasons. One, because institutions, they cannot go write a large check and buy a ton of properties because each property needs to be, renovated, designed, furnished, staged, built out, and producing revenue. Much heavier lift per property. So if you like the operational infrastructure that we have, gives us a really good moat when looking at how to feel about the space itself. So that side of it, and I also view it as a big roll-up play for an institution longer term, right? Institution looking for yield, we can go roll up the full portfolio each year and go sell that portfolio off. We also have the optionality of, okay, say we need to go sell certain assets. We can sell them kind of one-off to retail investors. We can go sell chunks of the portfolio regionally, right? Say all of our properties in this area, a family office there wants to buy them, right? We have a lot of flexibility in how we actually exit properties.
Gotcha. And then, so, if this market crash, a lot of people get laid off. Are you concerned at all that people would travel less, and so vacation rentals, short-term rentals is going to be
So what I think you're going to see, I think you're seeing a lot of stuff in the news, right? That short-term rentals are already going down, which before in short-term rentals, right? You could have two dudes throwing IKEA furniture into a house and it would do a 20% cash on cash. That is in no way the case anymore, right? People who are not investing in design, investing in experience, right, are getting their ass kicked. So what we're seeing, we actually had record bookings each of the last 7 weeks on our end. I think what you're going to see is you'll see less international travel, but I don't think you'll see people stop traveling, right? For us, even in our higher end houses in places like Scottsdale, right, we're still seeing, bookings go up, right? Because it actually is more economical staying in a house, in a 5-bedroom house in Scottsdale for a family versus staying in hotels, right? Once you're going to pass that 2, 3, 4 people mark, it becomes more economical and more experience driven to go stay in a house versus staying in a hotel. And I'm a hotel guy through and through, right? When I travel myself, but any kind of group setting, it actually becomes one, more economical, and two, just a better collective experience when looking at common space.
Gotcha. And so in terms of your property, like I'm sure you do, but what are some of the the key things you're looking for, the type of property that you would invest in because you know that it's more desirable, it can support a group like what you're saying. So give us a couple of like key
So
factors.
all of it's by market, right? We currently monitor about 260 markets in our own tech we built for underwriting. We also have a head of data science as well that measures both bedroom, bathroom count, zip code, neighborhood, layout, right? Certain keywords and listings that typically lead to better or worse bookings, right? So what you want to see in a market is what's the supply and demand look like for cash on cash in a certain type of property. For example, a big market we really love is Clearwater, Florida, right? Not too far from me personally, where you want properties there that are 5 bedrooms plus, because those are the ones that do well. But you also want to see in the market too is are there enough 5 bedrooms coming on market, 5, 6, 7 bedrooms where you can go buy enough of those to have scale in that given market, right? We plan on being in 20 plus markets by the end of next year. So for us, making sure we can actually have scale and there's enough inventory coming on board in those markets is really important, right? Because your margins go down, go up really quickly once you have scale in the market. If you only have 1 or 2 properties there, it becomes really tough to do that. So we want to make sure that we can have a future pipeline of properties, whether they're in fund 1, fund 2, fund 3, it doesn't really matter to us. More so we can have the economies of scale and kind of building out the billion market is a heavier lift.
Gotcha. How much is the asset under management for each fund that you envision?
We are just closing fund 1. It'll be about 35 million of actually equity. Fund 2, we have a target between 100 150, and then fund 3, we should pass $250 million.
Gotcha. So what's your
and then each one of those is kind of by year.
I see. And then so I know your big play is to then package this up and sell it to the institutional players. At what point is that do you have in mind before you would consider a sell?
When we get offers that make sense to exit, but I think more so in this space. So you can go off a T3 for an exit. This space is newer, has a level of volatility to it seasonally. So what we're seeing is institutions who have reached out to us already, they want to see a T24 or T36. Okay. So likely in the next 2, 3, 4 years, we'll kind of look at and start exiting earlier assets that we bought. But I'd say it's all optimistic, right? We take no fees at our GP level and don't plan to ever, right? It's more so our money's being tied to our exit. So whenever we can make an exit that makes sense for both us and our investors, we'll gladly go take that.
That makes sense. That's awesome. And just for fun, do you have a goal, like a dollar amount goal?
In terms of capital raised, dollars.
No, like exit, like how much you want to exit at, like if there's such a goal.
I mean, on my end, not really. It's more so, can we go overachieve our numbers? And I kind of view it more so like on the capital raise side, right? Equity under management versus assets. For us, we want to hit $1 billion, the next 4 years in terms of equity under management. Gotcha.
Yes, that's awesome. $1 billion. That's huge numbers. So for those that are listening and like they heard that and like, oh my gosh, like I could never imagine myself doing that. What would you say to them?
I think when you start giving yourself a lot more aggressive goals, right? If you start thinking differently as to how you go do that, right? Because if you, say you're just starting out like, okay, I'm gonna go do $1 million this year. Like you can scrap and claw your way to $1 million in a year, right? Just by, busting your ass. When you start, okay, how do I do $100 million that year instead? It changes your entire focus of how you think, because you're like, okay, these kind of grinding it out won't get you there. So it becomes really important to like, 1, be around people who think big, and then 2, shift your mindset as to, if I had to go do something that was 10 or 100x bigger, how do I go do it? Because you'll think differently in doing so. But I think the biggest thing is like start and do something versus like wasting time and thinking too much about what you're doing. Like do something, take some level of action, and it shocks you quickly, like how quickly things snowball if you're actually really doing the work.
That's great. Yes. And so if you were to restart all over again, like, the beginning of your career, is there anything that you would do differently or how you would start differently?
Honestly, I'm not positive, just because I think the single family thing, yeah, it sucked, but sometimes better be lucky than good. Like I got lucky with those houses and did really well in them, got all into, I think 10 single family houses for a total of like 30 grand down, cleared $1 million. And then when I sold them, off and, less than 2 years later, right? So that was kind of my seed money to go start investing with. And, help tell the story too. So I think I would have gotten to kind of working on the investor side of the house much quicker. But I think overall, like you look at, hey, would I have skipped school or like skip going into tech sales? I think all those things kind of help me move really quickly once I'm there. So like theoretically, I would have gotten bigger much quicker and kind of work on the investor side faster. But I also think too, the things that I did enabled me to go be more successful more quickly and make way less mistakes in doing so because I had that background.
Gotcha. That's good. All right, Sam, we're going to wrap up this section of our show today. If the folks want to reach out to you, learn from you, network with you, do deals with you, invest with you, where would you like to send them?
So I'm super active on LinkedIn. I post there 3, 4, or 5 times a week. And then also via email, if you ever want to shoot an email, it's sam@silvermancapital.co. Those 2 places I'm probably most active on.
Oh, that's great. Okay. And
I'll throw my email in the chat
there
too.
you go. Yep. Someone did it for you.
But
no,
it's
but
not
it's
the right email?
Silverman. It's not silvermancapital.co. All right.
Oh,
Yeah, we'll make
right.
sure that gets in there. Yes. All right. Any last words of wisdom you'd like to leave with us all today?
So I think a big thing that I think people don't talk about enough is like picking partners really selectively, right? Like I am go slow to go fast before you ever formalize a partnership, right? Like go deal by deal until you really know who someone is and kind of you really figure someone out. So especially if you're primarily being an allocator of capital versus true operator, right? Really do your due diligence, get references, do background checks, right? Really dig in to make sure that the people you're partnering with are good people, they're going to perform well. The ethical piece that matters a ton. Like I think a big thing, people get so anal about numbers, right? The gut check to me matters with someone, by far more than anything else, right? Like I manage my mom's portfolio for her whole retirement that I know if that goes to shit, I'm supplementing it, right? So I view it as if I want to put her money there with someone after talking to them, at least from a comfort level, like will I work with them? Absolutely no way. And also put your own money there first before you ever put investor capital there too, right? Like I think it helps on the trust side quite a bit.
That's good. Wise advice.